Everyone around us is always saying that we should buy real estate, and we all thought that when we grow up, we can easily afford a few apartments. You can rent out some apartments, receive a good rent, and live on that money. Sounds like a dream, doesn't it? But the reality is quite different. Real estate prices are always rising, and not every person with an average salary can afford an apartment for $100,000 or $200,000. In Europe, prices for 1 square meter start from a few $1,000s. Even a small studio apartment of 40 or 50 square meters will cost a lot of money. So, what to do then? Many people decide to take a mortgage. But even to make a mortgage, you need to pay at least 20% of the cost of the apartment. You also need a huge number of documents. For most people, this is not an option at all. Well, what should we do? Is it possible to start investing in property if you only have $100? In this video, we will talk about the best option for investing in real estate without a lot of capital. We are going to talk to you about what is REIT, ETF, and crowdfunding. Now, these words and abbreviations may seem pretty complicated to you, but trust me, by the end of this video, you will be able to figure it all out. Let's start with REITs. Buying real estate the traditional way needs a large initial investment, bringing a little return on investment, and you still need to keep an eye on an apartment or a house. The return on such investment can take a long time to materialize. As an alternative, you can consider investing in REIT funds. What these funds are and how you can make money on them, I will explain you right away. In simple words, REITs are funds that attract investments and buy real estate for this money. And when the real estate brings in the money, the fund divides the money among the investors. Now, let's get into more detail. REIT funds, which stands for Real Estate Investment Trust, are in a business of managing real estate or owning mortgage-backed securities. These funds earn income by building or buying real estate properties for the purpose of renting or selling them. In addition, they may invest in mortgage-backed securities. The profit that a REIT fund generates are distributed to shareholders in the form of dividends. I'll explain a little later what dividends are. REITs allow anyone to become a real estate investor, similar on how people buy shares of companies in other industries. So, how to do REIT funds generate profit? Most of them operate on a clear and easy to understand business model. They rent out real estate properties, generating a stable income in form of rent. This income is then shared with the shareholders in the form of dividends. So, how can you make money from REIT funds? There are two main ways. The first is receive dividends. Dividends are a share of earning that are distributed to a REIT stockholders. These payments can happen monthly, quarterly, or whatever. This makes this method kind of passive income. You purchase REIT shares, and over time, you are automatically credited with profits. The process happens without the need of constant monitoring. You buy and you just get paid. The second way is REIT trading. This is where you buy REITs at a lower price, and after some time, you sell them at a higher price. This method requires a deeper involvement as it's no longer passive. You need to keep track of market changes to make the most of this way of making money. Which method is better? Here, it all depends on your preferences and financial goals. However, I can note that both methods can be used in combination to maximize profits. For example, let's say you bought REIT shares in March at $20. Over time, their prices begin to rise. In May, you receive dividends and then sold the same REIT for $40. Thus, you profited both from dividends and the difference in price at the same time. REIT funds themselves can focus on investing in certain types of real estate. There are funds on the market that specialize exclusively on healthcare properties, warehouses, residential properties, and other categories. You can choose the assets you feel are the most reliable and appropriate for investing goals. REITs are a very cool tool because you can use them to protect your capital from inflation. After all, real estate rents usually rise in the line with inflation. Meanwhile, investors are exempted from service costs such as repairs, security, and property management. Why invest in REIT funds? Let's talk about the pros and cons. First, even without having a significant amount of capital, anyone can invest in real estate, since it doesn't require for you to have a lot of funds to buy property. Secondly, shareholders get the opportunity to invest in different types of real estate. For example, ranging from residential apartments to office buildings and warehouses. Third, like stocks of other companies, REIT funds are highly marketable. That is, REITs can be easily bought or sold on the stock exchange. Fourth, each shareholders receive their dividends regularly, providing a stable income. However, REIT also have their disadvantages. First, limited growth potential. Public REITs are required to pay out a large percentage of their profits to investors in form of dividends. This leaves a little room to expand the portfolios with the acquiring new projects. Second, the lack of control over real estate. Investors who invest directly into real estate have significant control over returns. They can select properties with high cash flow, actively rent the renters, carefully review applications, and implement other management practices. However, REIT investors are without these options and can only sell their shares if they are not satisfied with the result. So you don't own the property. You are simply investing in the projects and you don't have the freedom to manage the real estate. And there are also scams. Yes, even in this field, you can be fooled. So before investing, research a particular project in detail. The second option of real estate investment without much capital is crowdfunding. This method is similar to REITs, but there are still some differences. Real estate crowdfunding can be compared to participating in a book club, but instead of discussing books, you combine your funds with other people to invest in real estate properties. This approach allows you to start with a smaller amount that you would normally need to buy a real estate on your own. By investing your money in common fund through an online platform, you own a share in an investment property. These platforms take care of the investment managing, freeing you from the worries about the property management. Your profit will depend on how well the property performs. So, how do you make money from real estate crowdfunding? Let me give you an example. Imagine that you and your friends find an attractive apartment in Dubai. You decide to invest in it, buy that apartment, and rent it or sell it. The profit from the rental or sale is then distributed to all the investors. This is basic way of making money. Now, let's look at the pros and cons of this type of investment. Let's start with the advantages. First, you can invest in a project that you are really interested in and which meets your preferences. This gives you control over the choices of the object for investment. Secondly, the low entry minimum makes crowdfunding accessible to a wide audience without requiring tens of thousands of dollars to start. However, there are disadvantages as well. First, investments are made through specialized platforms, not on exchanges. Therefore, it is important to carefully study the chosen platform to avoid becoming a victim of a fraud. Second, you don't become the owner of the property itself. When you buy your own apartment, you can manage it anytime. Come there and do whatever you want. In the case of crowdfunding, you only invest in the project without having full freedom to manage the property. And the last method for today is investing in ETFs. Imagine you have 10 different apartments and you want to invest in each of them, but your budget is limited. In this situation, you might consider buying an ETF that combines all 10 of these properties. This will allow you to spread your investments across multiple properties, even with limited funds. This will help you diversify your portfolio. Real estate remains one of the most sought after and profitable investment options, attracting many people. However, as I mentioned earlier, buying and owning the physical real estate can be very costly. This is why some investors prefer to invest in real estate through exchanges traded funds like ETFs. These funds are a collection of securities from different companies. Real estate ETFs invest in companies that are in business of owning, managing, or financing real estate. These companies are known as REITs, which we have already discussed. Real estate ETFs work on the same principle as other regular ETFs. They are traded on stock exchanges and can be bought and sold throughout the day. Investors purchase shares of these funds through the brokerage account, similar to buying regular stocks. In investing through ETFs, there are two main ways to earn money similar to those available in REITs. The first is dividends. Dividends from ETFs can be paid monthly, quarterly, semi-annually, or otherwise. This provides a great passive income opportunities. You buy an ETF once and then make regular profits. The second way to make money is buying and selling. You can buy an ETF at one price and sell it at another. You can do this even within the short period of time, such as in a 1 minute. Now, let's look at the pros and cons of such investment. The positive sides includes the low entry threshold. You don't need to have tens of thousands of dollars to start. A small amount is totally enough. Second, ETFs allow you to create a stable passive income, which is especially convenient for long-term investments. Third, you can sell your shares at any time, which is useful in case of unexpected circumstances and the need of emergency funds. But there are also disadvantages as well. The main one is that you don't own the real estate itself, unlike with direct investments in real estate, where you can directly manage your property. In case of ETF, you invest in funds that manage real estate, and you don't own the property itself. As you can see, you don't need the hundreds of thousands of dollars to invest in real estate. I hope you found this useful and interesting. Go to our channel and watch more videos about cryptocurrency, finance, and earnings. Give us a like and subscribe. The Token team was with you, and we see you in another video.